It's been a volatile week for global markets, marked by renewed geopolitical uncertainty and sharp shifts in investor sentiment. Early tariff threats linked to Greenland briefly rattled markets and lifted gold to record highs before a softer tone at the World Economic Forum in Davos eased some of that risk. Investors are now weighing geopolitics, trade policy, and central bank credibility. Well, to make sense of all of that, I'm joined now by Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, it's always a pleasure. Thanks for talking to us.
It's my pleasure, Devin. Thanks for having me back.
Well, look, after a week that's taken in tariff threats, Greenland tariff threats, as I said, Trump-era rhetoric, and Davos diplomacy, what does this tell us, Mike, about how markets are pricing in geopolitical risk right now?
I guess we have to start with gold. It's up 12% on the year. The ounces of gold it takes to buy an S&P 500 has dropped to, as we speak, on January 22nd to 1.42. That's below the low at 1.44 in 2020. And it's below the peak in 1929 September at 1.54. So that's breaking down. The beta is breaking down versus gold. But when you think geopolitics, you expect to maybe see a bid in U.S. Treasuries. Now, we're not seeing that. Bond yields have been going up. Stock markets, meh, doesn't really care. But what's really unique about what's happening, Devin, is that we're seeing what quote unquote people are using the term flight to quality and things like silver and platinum and copper, and those aren't flight to quality assets. And so on my radar this year is the potential risk that silver is going to put in a multi-year high, that volatility is definitely going to, I think, pick up. That's my base case. But so far, so good. Remember, it's the beginning of the year. It's that euphoria and enthusiasm. Last year, this time, right in January, crude oil peaked around 80, corn peaked around 5, and they collapsed. I'm expecting similar risks in that early euphoria in Bitcoin, in copper, and even in bond yields, potentially rolling over by the year end for one key reason. U.S. stock market volatility is just so low, I think, for this pretty discombobulating geopolitical environment.
Yeah. Let's dig further into gold, right? I mean, gold has surged to record levels and it stayed there, albeit a little bit of up and down as we pass through the last few hours. Is this still about inflation and rates, or is it really about confidence in governments and institutions?
It's all the above. First of all, I like to say the gold market absolutely loves President Trump. Everything he says and does, so non-conventional, probably the most influential, significant president in my lifetime and potentially in world history. And he's at peak power, and obviously it's probably getting, where we're going to be 3 years from now. So gold's looking forward. Gold loves him. But the thing is, it doesn't really matter to me when we get this stretched in a risk asset like gold and silver. So right now, gold is about 2 times its 60-month moving average. It's rallying at the greatest velocity since 1979 and 80. And let's not underestimate the significance of maybe a market that has a supply-demand deficit where there was demand exceeding supply, particularly from central banks, and the rules of economics and invisible hand when the price shifts parabolic. So I think what gold's doing this year, I'll let everybody else focus on the fundamentals. I've shifted over to risk manager in gold. I've been bullish gold forever, and I'm jumping off that horse. Started late last year and now this year, like I did cryptos in 2024. I was early, but the key reason, it's just rallied too fast. And to me, it's signaling stuff that I find absolutely frightening. So gold grabbing alpha, like I mentioned earlier, versus S&P 500, versus Bitcoin, versus almost all risk assets is just plain frightening. But the thing is, when it rallies this fast, it shifts the supply-demand balance, and then at some point, it typically will put in a peak that'll last for decades. I hate to use that word, but that's just the lessons of what happens in gold. So I've known people who hold gold in their accounts forever, and it started lightening up. And part of the reason, so first, momentum can easily get it to 5,000, and then a normal correction in a volatile environment like this can easily get it to 4,000. So we are overdue for 5% days in gold and 10% days in silver, up, down, or both, and potential for this year to mark peaks that'll last for many years if history is a guide.
Copper is sending mixed signals, isn't it, Mike? I mean, tight supply, but softer demand signs from China. Which side of that story matters more at this point?
Short term, it's been up. I think copper is a worthy short this year, getting above 13,000 a ton, above $6 a pound. The reason I view it as a worthy short in the same bucket as Bitcoin, because as you said, mentioned earlier, if this economically sensitive and risk asset sensitive major metal continues appreciated above those key thresholds, it's a sign of global reflation, pickup in Chinese demand, and everything is fine despite all the tariffs. I think it's worthy to work against it. I think copper can easily revert towards $5 a pound and $10,000 a ton. Very normal correlation within a bull market. It get back to those levels and maybe it resets. I view the same in the same bucket as Bitcoin. The difference is copper is still a bull market, made record highs, and it's showing major inklings of risk going lower, meaning it's artificial reasons for now, shorter term reasons, supply constraints. Now, my copper team in London said these are probably not going to last very long. It's more of a balanced market. And also U.S. tariffs. They're all odd things to keep this risk asset appreciated. And to me, the number one prerequisite to be bullish copper, any industrial metal, which includes silver now, is the stock market has to go up. That's the U.S. stock market. That's the prerequisite. And if you're getting long these assets at these levels, in the precious metals, you've done okay, but you trickle down to industrial metals, copper, aluminum, iron ore, you're probably at greater risk of dropping at a much higher velocity than the stock market when it goes down. So to me, that's the major risk. And I'll mention the key reason I'm still quite concerned about the U.S. stock market, been forever. Volatility, 180-day volatility stock, and S&P 500 is about 11%. The average over time is around 19%, certainly since 2009. We're going to revert there. It's going to take some kind of catalyst. And then this, what gold's been doing versus all other markets, and Bitcoin rolling over. I'm very worried that copper is going to just drop to 5, maybe a little bit below, and along with things like peaks in silver and Bitcoin and in platinum.
Mike, rare earths are back in focus as trade tensions resurface. I mean, are these markets becoming more about geopolitics than security than, let's say, pure economics?
Oh yeah, well, you can't ignore the geopolitics, and let's remember some of the macro geopolitics that are really working well. Mr. Trump wants lower energy prices, check mark. All those trends are in his favor. He will get that. Now, we've had a decent pop in natural gas, but it's more short-term. Crude oil potentially still heading towards $40 a barrel in my grill. So he wants that. He wants lower interest rates. Well, how's he going to get that? Pumping up the stock market, pushing against the Fed is not a good way to get lower interest rates. In fact, it's the opposite way to do that. You're pumping up inflation and you're pushing against the Fed's ability to keep interest rates lower. So I think that's something he might realize is a key risk. But the key thing in metals is, yes, rare earth are a key part of it. It's part of what is getting America to the negotiation table, but no better incentive in the entire world for us to go back to our more organic supply of rare earths away from China. And the whole world is in that camp now. The deflationary forces out of China that the U.S. has pushed back a little bit have trickling down to the rest of the world, certainly in Europe, where they're supporting Mr. Z is supporting a war in their best customer's backyard. That's part of the geopolitics keeping gold bid. But I think, yes, it's a key part of it, and that's part of the reason I think gold has rallied so much. But I get to a point now that it's historically, it's just so expensive and so rich that this enduring bull in gold is no longer on that trade.
Right. Mike, I want to end up by asking you something about the physical metal and the stock itself. Let's stick with gold on that front, right? We had this conversation last year when we spoke about that lag between the mining stock and the metal itself in pricing. Where do you see that reconciliation happening this year? And let's talk about gold and gold mining companies and their shares in particular.
Well, the unique thing about the way I really look at that is I like to watch that Van Eck GDX index, Van Eck Gold Miners ETFs, and that's it was stuck basically dead for 10 years and finally popped up. And that's part of the gain that you're getting for the people who took the pain. And it was very significant pain. So where it's going to go from here, I'm less certain about that, but I'm quite convinced that we're near the end of a bull market's peak euphoria in gold and silver particularly, and potentially copper, which means all the miners will have issues. But overall, I think that it might work out the way the energy miners have been doing versus the actual energy, the energy producers, XLE versus actual energy. I mean, XLE is doing fine. That's the energy ETF, despite energy prices going lower. It might be similar in things like GDX in the miners because they can make money. Even with gold dropping back to 4,000, they still have some decent revenues. But my point is overall from these levels, they're just so stretched. After you've taken such extreme pain and finally got some great gain, typically, as I see in gold and silver, and platinum and copper, prudent profit taking is more I think the right thing to do versus piling on at such elevated levels.
Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Always a pleasure for the insights, Mike.
It's my pleasure, Devin. Looking forward to the next time.